We're live.
Good afternoon and welcome to our weekly Tuesday class at noon. Is it a pleasure to have you with us? And of course, it is a pleasure to be here with you. I am Nicole Bako, an IRA specialist here at Quest. We have a very special guest with us today. Mr. Martijn Dekker is with us to discuss energy portfolios in the changing energy market. He is with a company called Renewables. I hope I said that right. I had the pleasure of getting to co-host this panel this weekend at our Quest Expo. I hope all of you got to go. If not, you'll have to wait for the recording to come out to see what you missed. So without further ado, I'm going to start introducing the class, and then we'll get to the man of the hour so we can learn about this amazing topic. Of course, the oil and gas industry is one of my favorite asset classes to discuss. So here we go. All right, so for those of you who are kind of new, who is Quest? We are the largest self-directed IRA custodian in the great state of Texas. We have about 22,000 clients across the country. So no matter where you're joining us from now, we are able to serve you. We have about 2.2 billion assets under administration. Notice it's not under management, since the accounts are completely self-directed. We'll get to that meeting in just a second. We have about 110 employees in our three offices. Our main office is Houston, and then we have Austin and Dallas. That is the foghorn to let me know the chat box is going off, so you can connect with us online through our chat box. I'll turn that off in just a second, guys. So we do have about 110 employees for our three cities that we're located in Texas, with about 36 certified IRA service professionals. I myself, I'm an IRA services professional, and I actually just got my CISP in June, and that was really exciting. And we have $450 million in undirected cash. This is cash sitting in our clients' accounts that's undirected. It's not being used. It's just sitting there waiting to be used. So think of this as an opportunity. I often hear like, well, I don't really have the money to invest in that. Well, this is a way that you can access that. So just pay attention to that. I'm going to talk about that a little later. Of course, our disclaimer, Quest does not give any legal, accounting, structuring, tax, investment, what have you, advice. This webinar, like all of our webinars, is for education purposes only. Please make sure you are doing your due diligence on the people and the investments that you are engaging with. Please make sure you are contacting your CPAs, your attorneys, those financial planners, your what have you, to make sure that you are really doing your due diligence, consulting with those professionals before entering into any investments. So on to the really good stuff. What is a self-directed IRA anyway? To be honest, we made it up. Self-directed is a completely made up marketing term, and it just means that you are completely in control of the IRA. You are directing it yourself. You actually tell us what you want to do, and we do it. You're choosing all of the assets in the account. Here at Quest, we don't hold anything publicly traded or anything traded on an exchange. So Dow Jones, commodity markets, what have you. We can't hold stocks, bonds, mutual funds unless they're private, of course. So self-directed, the IRAs here are just like the IRAs at a Fidelity or what have you. The contribution limits are the same, but here at Quest, we have an open architecture platform so you can invest in private assets like oil and gas that we're going to discuss soon, notes, real estate, what have you. So it really gives you a very broad spectrum of investments to invest in, and you are completely in control of that. So what are some benefits? Diversification, whether it's an addition to an existing portfolio where you are investing in publicly traded stocks, what have you, and this is an addition, or because of the number of assets you can invest in the self-directed IRA, it's really diversified in its own right. Tax savings, all of the accounts we have here at Quest have some sort of tax savings to them, either maybe in a tax deferred way, like in a traditional IRA where that's pre-tax money and you're deferring or delaying when you're paying those taxes at distribution when you retirement, or the Roth IRA, which is a tax-free account If you have it open and funded for 5 years, wait till 59 and a half. Everything comes out tax and penalty free. I would love to tell you more about the Roth IRA and tax-free distributions for tax-free retirement. But of course, we don't have time for that now. So please make sure you call your IRA specialist or myself. We'd be happy to help you with that. Social investing, I think this is an amazing advantage. So you can invest anywhere you want. Doesn't have to be in your local community. Of course it can. You can provide jobs to people by funding like a fix and flip. You can give somebody a mortgage that can't really get one from like a conventional bank by doing seller financing. So lots of opportunity for that there as well. And then of course, invest in what you know best. Maybe you don't know anything about the stock market, but maybe you know real estate really well, or oil and gas, or notes, or what have you. So this is where you can use the education you already have to help yourself invest for retirement. So I think that's really great. These are the 7 accounts we have here at Quest. We have the 2 personal plans, the traditional and the Roth that I was speaking of. We do have 3 employer plans for those of you that are self-employed. And we do have the 2 specialty plans. These can give you tax-free distributions now for qualified expenses, health expenses, of course, for the health savings account, and qualified education expenses for the Coverdell account. Of course, happy to help you with these. If you call us and set up a consultation, we'd love to help you out. These are some investment choices. These are the 3 main asset categories that people invest in. I really kind of think this is a short list. There's so many other things. People hold cattle in their IRA. Now we can do cryptocurrency in our IRAs. Of course, oil and gas is here. It typically ends up being a private entity investment because you're typically investing through like an LLC. So just an example there. We make it really easy to do this. Our normal processing time is 24 to 48 hours. So open the account as an Adobe Sign link. We can help initiate that transfer to get your funds moved over. We have networking and education opportunities to help you locate that investment. We have some supporting documents that we can help you review and correct, and then we can send out the funds within 24 to 48 hours. So we make it very easy for you. Of course, we love that free education and networking opportunities. So just like today at noon, Saturday at noon, we'll have another special guest with more information on self-directed IRAs. The virtual networking or national networking happy hour happens to be tomorrow for this month. It's the 4th Wednesday of every month, 6:30 p.m. Central. I am hosting it. I make it very fun. Please come join me. It's for people in Texas, of course, for people out of Texas that can't make our in-person events. Please come join me. Sign up on the internet on our website. We'd love to have you. It's a great event. Come have a beer, come have a glass of wine. We'll make it really fun. Meet some new people that also have like-minded investments like you. If you can't make the rest of this class or whatnot, all of these are on our YouTube and Facebook channel for you to access at any time. Our in-person events have this schedule: Houston, 1st Tuesday, Austin, 2nd Tuesday. Our Dallas office is the 3rd Tuesday, and they all start at 6:30 Central. They are catered. We have some drinks, we have education, we have networking, and you are allowed to deal pitch at the end. So many opportunities for that. For this class, we have a special offer just for you because this is my favorite topic to talk about, and it is the end of the month. So free accounts. We are waiving the $100 account opening fee through the end of the month. So call me, contact me. I would love to show you how to open that account free so you can invest in these great investments, these great asset classes for retirement. We'd love to help you out. So I know Sarah Shellum, our amazing marketing blog content writer. She does all of those, and we, of course, could not have done the expo without her. So I know our amazing moderator, Sarah Shellum, is putting these information in the chat box for you as fast as she can. So we're getting this information out. Okay, that is quite enough of me. Here are some more ways to get in touch with us. That chat box Fognor is hearing, that is our chat box. So If you go to our our website, you're actually chatting with us, the IRA and transaction specialists. We're happy to help you. I love our phone number, 855-FUN-IRAs. We really do think this is fun. We love helping people retire, educate them on this new way of investing. And of course, our emails are below. You can email me personally or the IRA specialist as a whole. Okay, quite enough of me. Everybody's done hearing from me. Let me close this out. Get this off the screen. Okay, now it is, I am very proud to introduce the man of the hour, Mr. Martijn Dekker, to talk about the oil and gas investment opportunities that they might have. And it's from Arivos. I hope I'm saying that right.
Absolutely. You got it absolutely right.
Awesome. Well, thanks so much for being here, Martijn, and take it away.
Thanks. I really thanks all for joining, and I'm really excited to be here because talk about energy. It's so fundamental in our lives. It's together with food, a roof above your head. Energy is one of the most essential things we have, and I think as this world this year has shown, if you think about the Ukraine war, it's something we can't take for granted. Like here in Europe, here in the US, we're complaining about high oil prices, but like in Europe, they may be in the cold this winter. So energy is very essential. So it's so important that I think it should also be part of people's investment portfolio. And what I really like about this opportunity to actually educate people about energy and the investment opportunities there is, because a lot of investors, they're kind of confused and say, well, how can I really invest in energy? And it's kind of understandable. There's like headlines about high oil price, low oil price, gas prices crashing, people talking about the energy system changing, renewables. So it can be kind of confusing. And what I like to do in like this webinar is kind of demystify it a little bit and just show that it's actually a business, any other business. It's about risk mitigation. It's whether you want to buy and hold. It's whether you are interested in cash flow, whether you're interested in value. The experience of a team, always important. It's basically like any other business. So I'm super excited to basically educate you, both as investors, but also as citizens, because it's so important to our lives that we probably should understand a little bit more about it. And that's maybe the big takeaway is that like smart investing in energy is actually could be a low risk path to wealth creation. So I'll share some of my insights and a little bit on my background. I've got about 25 years, probably a little bit more now in the energy sector. 20 of the, and I spent most of it in Shell before I co-founded with the two partners Arivos. So in Shell, I covered everything in the upstream side, which is basically the exploration, development, and production of oil and gas. And I spent some time in the midstream part, basically how you transport oil and gas from its production point to whoever needs to use it. But in the last 5 years, before I started Arivos, I also spent in Shell's headquarters in their strategy department, where I did a lot of the work on clean energy, like what's the strategy for clean hydrogen, what is carbon capture, how does that work, how do renewable power, how does that fit into things? So we also got a view on where you should invest in that clean energy. So I'm very excited to kind of share my insight with on both conventional oil and gas and clean energy. So what I'll do is I'll kind of split the session basically in 3 topics. So first, I think it's always actually good to start at the fundamentals. So I'll talk a little bit about the fundamentals of the energy system, supply and demand. Then I go a little bit deeper on oil and gas. What are the ways how you can actually invest in oil and gas without taking a lot of risk, but keeping access to the upside? And then I'll finish talking about the opportunities in clean energy. And hopefully by the end, there should be plenty of time to ask questions. So let's launch into it. And it's always good to start about energy demand. And this is a really big macro picture. So if you think about it, what's energy demand, world energy demand, or energy demand for a country, what is it really based on? It's actually pretty fundamental. It's based on only like 3 things. It's like how many people do you have, how rich are they, like how much energy can they use, and how efficient do you use that energy. And I like kind of this chart. You think I stole it from a Shell presentation. It's all online, so you can look it up yourself. But if you fundamentally look at the whole energy sector, compared to where we are today, energy demand, which is that yellowish band, is expected to double through this century. So if you think about the fundamental of the energy industry, it's actually pretty good, because if something is going to double in demand, that's probably a good investment opportunity. The one thing to highlight here is you can see the inputs into it. So GDP is how rich the population will be, and population, which is projected to grow. And a big assumption here is that even with doubling the amount of energy that the world will need by the end of the century, that assumes heroic assumptions on how much more efficiency we're going to have in our energy use. So if anything, the doubling of energy is probably a conservative measure. So that's always good to think about what's the demand of the product going to be. It's not in this chart, but it's interesting to think about where does the demand come from, and it'll come back later. And at the moment, about 30% of the energy demand in the world is coming for industrial use, so plants, etc. 30% is going into transportation, driving your car around, flying around, sending boats across the world. And 20% is to heat up buildings, to keep each other and to keep us warm. And 20% is like for other uses. So if this is the energy demand scenario, let's look at supply, because that's, of course, important as well. And this is actually interesting to see as well, what's the mix of energy supply that goes to meet that demand. And I think before talking about the numbers on this slide, it's interesting to think about what is primary energy and what is secondary energy. Because a lot of people at the moment talk about electricity and how much renewable electricity there will be. But electricity is a secondary energy. It's generated by another form of energy. And if you think about primary sources of energy, it's like oil, but of course we all know gas, coal, nuclear, wind, and solar. They're all forms of primary energy. And it can get transferred in other forms of energy, like electricity, or in the olden days, or maybe still in some places, steam. That's actually how a lot of the energy industry started. Or hydrogen, which is the new kid on the block. You can actually transfer all kinds of forms of energy into hydrogen, which you can use for other things. So I think it's good to think about this, provides some perspective on all the things we're reading and hearing about renewable energy and how this is going to transform the world and how we're going to move away from carbon energy, say oil and gas, coal, to renewable energy. And it's definitely a trend that has started. You can see the chart on the left-hand side of this graph, which shows the increase of energy from biofuels, solar, and wind, which is on a steep incline. But it's on a steep incline from a very, very low base. And if you look at the chart on the right, there are like 4 different time horizons, like the next couple of years, 2050, 2075, and 2100. So it's way in the future. But one thing is interesting to see is that, yes, in the long term, projections are that some of these forms of renewable energy will be a much bigger part of the energy supply mix. And then the green and the black and the red colors, that's actually hydrocarbons. So you also see that for the next couple of years, 2055, conventional oil and gas and coal will still be a significant part of the energy mix. And that's, I think, is good to understand is when we look at this space. Because what you see is what you get often in the headlines is the exponential growth of renewables, which is definitely happening, but it's starting from a very slow base. So at the moment, if you look at the entire energy system, only 2% is served by what we call modern renewables, like biofuels, solar, and wind. And that's projected to grow, and it's projected to grow significantly, actually an increase with a factor of 5 by 2040, where it's going to be 10%. So that's a huge amount of investment that will be required, but it also makes the point is that oil and gas is going to be needed to keep the world moving, to drive our cars, to heat our homes, and to keep industry going for a long, long time. So even that provides a significant investment opportunity as well. The opportunity for both actually clean energy and oil and gas is bright. And what a lot of, I would say, like more intelligent, more informed people will say is when we talk about energy transition, it's like we need to do and. We need to be more efficient, more energy efficient, more environmentally efficient how we produce our oil and gas while we're building that new lower carbon energy system. So these two slides I showed are kind of long-term trends, and I think that's good to bear in the back of our minds. But let's also look a little bit, or in fact, this kind of makes that same point is I just made. It's actually worth pausing a little on. Is that, as I just mentioned, is that oil and gas is going to be staying relevant for quite a long time. And these are two charts that show the projections for natural gas production and oil production. And if you see the kind of the tan line, which shows is if you don't invest anything more, just produce out what's discovered right now, that's actually below what all are the scenarios that very smart people come up with on how the world could develop. It's a lot less. So it means there's a lot more oil and gas production is needed. New things need to be added in all these scenarios. And even the most aggressive scenarios, which, for instance, the light blue line is, which is a scenario which actually gets the world to 1.5 degrees Celsius, or keeps it under 1.5 degrees Celsius heating. So even in those scenarios, we can see till 2040, 2050, still significant amounts of oil and gas production. So let's shift a little bit to the short term and the outlook for oil and gas. I think what's interesting to see, if you remember the last chart, which shows that the world will need in all scenarios either a very rapid transition or a slower transition to lower carbon energy, then all these scenarios is significant oil and gas production. Well, that oil and gas production, by the nature of that, it's you're basically producing existing reservoirs, so you always got to replenish it, needs a lot of investment. And if you look at the chart in the top left, the amount of investment in oil and gas has decreased significantly in the last couple of years. So that sets it up. That's kind of begs the question, well, the world needs more oil and gas to keep going, and you invest less, that probably means that we're going to head into a problem. And I think that's exactly where we are today. I think the whole dynamics in the oil and gas market have been a lot overshadowed by the war in the Ukraine, and the increase in prices that we've seen in the middle of the year have been attributed to that. But I think what's much, much more important is the underlying trend of significantly underinvestment in oil and gas over the last decade. Another good trend that kind of shows that how the last 2 years have not been in line at all with normal trends is the picture below, which shows the U.S. rig count versus oil price. I mean, it is the oil industry has been somewhat cyclical. So if the oil price is low, you drill less wells because there's a little bit of oversupply. And then when the oil price is high, you start producing more. And you can see that for like 2016, 2020, 2017, 18, 19, they fall kind of in a band. Yes, I mean, if oil price is higher, you got more rigs working. And if oil price is lower, you got less rigs working. What shows that 2021 and 2022, where oil price is going up because of the dynamics of not having enough supply to meet world demand, normally you see an increase in rigs. And although we've seen a little bit of increase in rigs, it's way outside the band what we've seen historically. So it just supports the thesis that there's still significant underinvestment in oil and gas. And that's why all the big banks, whether it's Goldman Sachs, Morgan Stanley, UBS, they're all projecting significantly higher oil prices by the end of the year and into next year. And I think that happens in the background of some of the highest inflation we've seen in the last 15 years. And I think what's interesting to think about that on how oil and gas investment in particular, how does our energy in general how that behaves in both an inflationary or a recessionary environment. So think about the inflation first. In fact, part of the inflation actually has been driven in the increase in energy prices. It's definitely a strong component of it. And in generally, commodity prices kind of rise with rising inflation. So it's typically been a pretty good hedge to be in commodities. And I'll show some quotes from Goldman Sachs next. From a recessionary point of view, it's kind of interesting to think about when I mentioned before that where the demand of energy is coming from. About 70% of demand for energy is coming from fundamental human needs. It's like heating our houses, getting around, driving our cars. So those things will happen whether we're in a recession or not. There may be a little bit of dial back on industrial activity, but 70% of it is really not that related to the economic environment. So from a fundamental point of view, oil and gas is reasonably recession-proof, particularly with the background that there's been so much underinvestment. So we're already looking at a deficit of oil and gas supply. And just to emphasize that, I thought it'd be good to share some insights that Goldman Sachs put out a couple of weeks ago, where their projection for 2023 is that we may not be in a recession yet, that may be a little bit later, and they think that commodities are a really good way to play that late cycle, where demand is still above supply. And again, that's against a background where, from an underinvestment point of view, supply is already kind of short in meeting the demand. So they see for more tightening in those markets, and particularly for oil, they think that's actually the best commodity to play in the near future. And if you see what oil is today, between $70 or $80 per barrel, they project $130 by year end, which I can clearly see based on the market dynamics. So that's kind of a high-level view on fundamentals. I think it'd be good to look at some of the specifics on oil and gas investment. And this is where I like to just kind of unpack, well, how do you approach investment in oil and gas? And like all things, I think it's just an opportunity or it's a matter of managing a risk. And I'll touch on the things that may be kind of specific to oil and gas. So first, whether you're a private or a public investment, I think everyone kind of knows ExxonMobil stock, which is one way to play oil and gas. But I think we're at a time in the markets where there's a significant dislocation between the value of oil and gas and how public oil and gas companies are traded. Because one of the reasons we've seen this significant underinvestment is this barrage of counter arguments against investing in oil and gas. As what people call like ESG, and there are funds that don't want to invest in oil and gas anymore. And it all feels good for people. Oh, well, let's not do that. Well, as I've shown before, the world needs it. If we all want to keep our houses heated, we want to drive around, because this energy transition is a transition. It's not something we can throw a switch on. And public companies find a lot more headwinds on that. And you're also kind of subject to the vagaries of the public markets. Like if the whole stock market goes down and the oil price stays where it is, well, ExxonMobil will go down with it, just because that's the market sentiment. And we strongly believe that, particularly for oil and gas, that private investments may be a better way to play it, because you can just look at the fundamentals of the asset, just what cash flow have I got coming in, how are my assets appreciating, and you have a direct link to the assets, and you don't have to go through the sentiment of the market, both on a macro basis or on specifics to the sector, like headwinds because of ESG reasons. I think the other thing looking at it is, are you in it to buy and hold or buy and sell? I think it's very similar for, if you think about real estate, are you buying it to flip a property, or are you actually buying it for cash flow? And I think our approach definitely is a long-term view that we got in our renewables. When we buy an asset, we're going to be there in for the long term. If someone offers us a better price for it at some point, yeah, of course we'll entertain it. But we see ourselves as long-term owners of these assets, because only then you take care of it, you think about the long-term value of the asset. So we're definitely very long, and we're a buy and hold. Now, it doesn't mean that you can't play buy and sell in oil and gas as well, but it's a different risk profile, because a lot of things got to work out right for something to work in the short term. The next thing is, which kind of similar, is whether you're in it for cash flow versus value. And a good example for a value play, which would be a higher risk, is you buy into an exploration prospect that still has to be drilled. You can probably buy it pretty cheap, but that's because it's high risk, because there may be only 10, 20, 30, 40% chance that you actually find oil and gas. And when you do, yeah, there's a significant increase, and you got an opportunity to make your money back 3, 4, 5, or even 10 times. But it's a risky endeavor. On the other end, you can just look at cash flow. You'd buy an asset, a couple of producing wells that have some operational improvement opportunities. There's maybe some infill wells, which basically drilling into already proven reserves. And you're really driving for the cash flow, for long-term cash flow. And I think you're probably already getting it. In Arrivas, we manage our downsides. So we buy cash flow plays. We want to see cash today, and that will give us opportunities to reinvest in the business and keep that cash flow going. And often questions asked next is whether you want to be in oil versus gas. I mean, the different markets, as you see, this year is quite interesting, where the oil price went from the beginning of the year about 70 to about 120, 130, and I think we're back at 70. Gas prices quite decoupled. In the beginning of the year, $3, and it's now around 7, 8, and almost touched 10 earlier this year. The different dynamics in these markets, and sometimes and often they move in sync. I think our approach is that if you got the opportunity to make your portfolio more balanced, and have almost like an equal exposure to oil and gas, that could be quite good. Now, at the moment, our view is, as you've seen, supported by some of the Goldman Sachs statements, we are very bullish about oil long term, but equally, in particular in North America, we're very bullish on gas. I think what we see happening in Europe, where there's a lot more demand from gas, not from Russia. The US can play a big role in that, which will underpin a lot of the demand for gas. And even in the US, if we move to a more renewable system, there needs to be a lot of backup of actually oil and gas, particular gas power, for a long time. And there's still an opportunity, particularly domestically, to move a lot of coal from coal-fired plants to gas-fired plants. So we're also very long on gas. And that's why at the moment we play in both sectors, and I'll show that a little bit later. Then as an individual investor, there's always it's a question as well, do you want to play on the debt side or the equity side? And I think it's, again, a matter of managing your risk profile. For example, at the moment, in Arrivas, the owners and some co-investors put some equity in it, but we also got a debt offering. So the debt offering would be senior to any other liens, any other obligations the company has. So it's really well protected and it's very low risk. Whereas equity, well, you got a little bit more exposed. So I think it's a little bit a matter of your risk profile. If you touch the right button on the other points I made before, even equity doesn't have to be a very high risk venture, but it's generally, of course, more risky than debt. Now, having mentioned all these points, it's always bracketed. If you talk about oil and gas, the big thing is, of course, what's the oil price or the gas price, and on the other hand is what team or what experience do you have, and those are absolutely fundamental. And I think if you're investing oil and gas, one thing I think I would be very aware of, if people say, well, this is a great play if the oil price goes up, or if the oil price, if it's high, stays high, this will be great. And that's very risky, because as you all know, that doesn't need any education. The oil price was negative 2 years ago, and it was 130 years this year. So it's quite volatile. It could go all directions. And the only way in our mind to play an investment as oil and gas is just asking, well, what's the break-even price? At what point do you get your money back? What oil price does this still work? And so in Arrivas, we're quite conservative. We're not getting in things that need oil prices above $30 to break even. Now, that's not where we think oil prices will be. We think it's going to be a lot higher. But we say, well, are we robust if oil prices really go down very low? And if you think about $25 to $30 over the last, say, 10, 20 years, that's about as low as it gets on a sustainable basis. So as long as you're robust there, you make sure that your investment is protected. We don't really believe playing the oil markets and banking on oil price to go high. You can do that as well. You can just buy oil futures and play it that way. Very risky. So that's something to keep in mind. And then on the other side is what's absolutely key, like for any business, you got to have a very, very experienced team that know what we're doing. If you think about our company, is we've got all very experienced folks that we either got from Shell or from other independents that really, really, really know what they're doing. What's also nice is that, and it's a little bit related to if you have a private investment with a smaller company, you got a lot of advantages, because what we are doing, we're bringing like big oil company thinking to a small company, which means we can move fast, we can deploy it where it's needed without all of the overheads and the slower response time that big oil companies have. And I think I got the question asked at the expo that Nicole mentioned in the introduction this weekend on, well, what's your approach to technology? Because isn't that technology for big companies? And I think a lot of the technologies, the latest technologies in oil and gas, they're pretty much available for people who want to apply them. And I think the quote I gave this weekend is, like in Arrivas, we want to be at the leading edge of technology, but not the bleeding edge. The big companies, they can bleed money in trying to develop new things. And I think we're very thankful for them, because we can probably use those technologies in a couple of years when they're available to everyone. We're just using the leading technology for now. So this is like generally the decisions or the considerations you can think about when you want to invest in oil and gas. And there's no right or wrong. It's all related to your risk profile. At Arrivas, our mantra is that we want to be protected against the low side. We want to have low risk with upside. So that's why we're private. We're not exposed to the public markets. We buy and hold. We're in this for the long term. We're not depending on an exit, a sale. We just make value of the asset as is. So that leads us more to cash flow over value plays, particularly in the current environment. We're balanced on oil versus gas. And as an individual investor, you can play a debt versus equity. And in Arrivas, we'll have both opportunities for investors. So let me talk a little bit on how, because I talked what we're doing in Arrivas on how we applied it, and what I just told you how we actually applied it in our business. So let me give you an overview of our two big positions. I talked to you about balance of oil and gas. So we got a predominantly oil position in the Permian Basin, and we got I'll go back to it later, we got a gas position in the Rockies. And they're really nice because they're offsetting each other. So the Permian Basin is a perfect example. The asset we bought was from a company who wanted to get out. They underinvested in the asset. They didn't optimize the wells. So we bought the position. In 3 or 4 months, we tripled production. We brought some shut-in wells back to life. We did some workovers. We changed the compressor settings. Basically, we gave it the attention that it needed, and with very little investment, we tripled production in 3 to 4 months. And then what I'm very excited about at the moment, and you can see the picture on the right, between the producing wells we bought, there was some acreage in between, which we leased, and we're drilling infill wells. Very low risk wells. The reservoirs have been proven. It's just a matter of putting these horizontal wells in. And we just started a 20-well drilling program, and we're just about to complete the first 2 wells. So we're very excited about that. The business model is very similar to what I explained. We bought it for the cash flow. The cash flow is coming in, and we're using that to fund our drilling program. If you look at the next slide, that's a gas position in the Rockies. It's also it's a steady producer, so these are conventional wells. The nice thing about conventional gas wells is that they just keep going. So if you think about cash flow investment, you buy the production, and it just keeps going for years and years and years with not a lot of decline. So they're really, really solid producers. Very interesting, similar concept. What we're doing here is we've got a lot of wells. I think we've got about 400 wells across Utah and Colorado, and we're just doing workovers. So some of these wells have been producing for a long time, so there's like debris and gunk building up in your well. So one by one, we're just going through these wells and cleaning them up, and they double, triple production. So it will be a long time before we get to all the wells, but it means that it's a great way with not a lot of investment to maintain the production from this asset. I think another great advantage here is, as you may have heard, in Colorado, it's a little bit more difficult to get permits than it is in Texas. And the fact that you have existing well bores that you can actually optimize and increase is perfect, because you don't actually need new drilling permits for them. So this is our gas play, and that was the oil play. And I think I talked about the whether you could invest in equity or in debt. So debt is one way to play it, and I'm giving here the example of the fund that we have open at the moment, which is a debt fund. So I think we're raising about $5 million, and we're offering a 12% annual return for 3 years. And basically, the lenders will receive all our assets in the Permian as collateral. And given the cash flow that's projected from these assets at reasonably conservative oil prices, is very much over collateralized. So it's a way to, if you want to invest in oil and gas, is to invest in like debt offerings from private companies like ourselves. So that's one way to play it. Later on, I think we're planning maybe an equity offering, for example, where investors can participate in some of our low-risk drilling activity. We don't have that open right now, but that may come later this year. So maybe let's switch gears and talk briefly about clean energy. And I like this picture. I think you can't see it that well, all the labels, but that's probably okay. It shows that the energy system is very complex. What I like about this picture is that because it's so complex and so integrated, I think one of the big opportunities to play in the new and clean energy space is actually by integrating it where there's integration with the existing energy system. Because it took us about 50 to 100 years to build the existing energy system. I mean, trillions of dollars that went into the current hydrocarbon-based system. And it will take the same, if not more, investment to transform to a system that's more based on renewables. So that will take quite a bit of time. But I think we can make it better and make it faster and actually more efficient and more interesting and more profitable if we can use what's already been built in part of building a new system. And those are some examples I think I got on the left-hand side of this slide. Biofuels, which is great, particularly if you got drop-in fuels, which means that you got a biofuel that looks and behaves exactly the same as normal gasoline, so you can drop it into the existing system. Same as carbon capture, use and storage. If you capture the carbon, it needs to be sent somewhere, so you can use the same pipelines that you've been using to sending gas. You can use wells that were already drilled for oil and gas. You can use it to store CO2. Similar like offshore wind, as I showed, you need significant amounts of oil and gas in the future. But you can make that oil actually less energy intensive by producing it. For instance, by using electricity to power some of these offshore platforms. And there's some other examples, like clean hydrogen. It's similar. It needs to be transported, and you can use the existing pipeline network for it. You can use existing storage facilities for it. So I think there's a lot of opportunities in this clean energy, because if you think about it, if people are seriously investing in it, and they should, because in a lot of places in the world, actually particularly in the US, solar and wind are often the cheapest form of industry, cheapest form of energy, even if you dial in things like storage costs and transportation. So it's definitely worth looking at it. It just will take a long time to build, and you got to selectively look where you want to invest in. So let's talk a little bit about that. If considering investments in clean energy, ultimately it's always about the business fundamentals. Do you actually invest in a business that's got good fundamentals? Does it have a good team? Does the business plan add up? When you do your diligence, it all stacks up. And here's a couple of things that we look at. Is if you look at the clean energy, a lot of people are always talking about the growth, how big it could be, where it could grow to. And I think that's great. But I think the way we are playing clean energy is we want to see a way where this will generate positive cash flow in the near term. Now, it may not be as much that is the developing cash flow today, but if we see projects where, for instance, a plant has to be built and it will generate positive cash flows the moment it comes online in 2-3 years, that's something that's interesting. And that leads a little bit to the technology risk. There's a wide range of investment in clean energy. And again, it's a little bit analogous to oil and gas. Is what's your risk profile? You can invest in a new type of new type of equipment where you can generate hydrogen, which is very much in vogue and everyone's talking about it. But if it relies on like a lot of new technology that's still in the lab, yes, if it works, it could be great. And maybe 10 years from now, it could be a unicorn, $1 billion company, but there's a lot of risk related to it. On the other hand, you could take an existing technology that just needs to be deployed. I mean, it's all been proven, there's a demonstration plan and everything works. So from a technology risk, our approach is we don't want to have any technology risk. The technology needs to be de-risked and needs to be ready to deploy. But depending on your risk profile, there are different ways you can play it. Then I think what we also look at in the underlying business is the capital efficiency. Because as I mentioned, it will take a significant amount of investment to build this new energy system. So if you can get more energy out of the same amount of capital, ultimately that'll be a winner. So that's something to look at is, how actually efficient is this capital to generate more energy? And talking about clean energy, of course, you're going to talk about carbon and CO2. I think that's a very important metric to look at as well for clean energy investments. If the purpose is to build these clean energy sources to reduce carbon emissions, well, wouldn't it be logical then look at the business and say, well, how much money do we spend and what's the carbon efficiency? How much money per dollar of carbon do we actually have to pay to have a form of energy that has less carbon? Because ultimately, I think rationality will catch up there as well. There's some forms of clean tech that project that it takes $300, $400, $500 per ton of carbon to actually make sense. And maybe if the carbon price goes there at some point, that's great. But wouldn't you first invest something that only takes like $20 or $30 or $40 per ton of carbon to actually take that same CO2 out of the air? So I think that's a good metric to look at on how sustainable and actually how robust the business is. Then in clean energy investment, often like the price offtake and asset utilization, if you can get guarantees for that, which leads a little bit to like what government support there is, it's probably important because it's unlike oil and gas, the markets are not that well developed. So you're much more exposed to volatility and uncertainty. So the more can be locked in guarantees, I mean, the better off you are. That brings me kind of to the last point on this slide is where do government fit in? In particular, the Inflation Reduction Act, which I can't still got a hard time saying it because it's one of the most inflationary acts I've ever seen. But it's called the Inflation Reduction Act, but it's got a lot of goodies for the green industry. And I think when we look at a business, I think it's important that we see a business that can work without government support. But it doesn't mean that as the business is starting up, that it can be a significant help to get the business to scale where it is sustainable without government support. So the Inflation Reduction Act will add significant amount of investments in the clean energy, and I think businesses can and should take advantage of that. As an investor, you should always ask, okay, well, what if that subsidy isn't there, and how sustainable is that business in 5 to 10 years? But it can definitely help launch the business and get to positive cash flow soon. So it's an important element to look at. I think similar as on what I showed for oil and gas investment, this is bracketed again. Is call it a price tag for CO2, which is like a misnomer, or it's like a proxy for where are the incentives, what are the expectations of the world? Because if we don't value CO2 being reduced, then a lot of these sources or these investments don't make sense. But there's generally a consensus that we want to price in some cost for CO2. And on the other end is the team, absolutely critical, having the right team that can execute the opportunity. So let me give one example as we're getting to the end, what we're doing. This is actually, we're leading the investment in a biofuel company. And I think it's a perfect example how this fits our thesis. So it's a biofuel company that's investing in renewable gasoline. The technology has been de-risked. And I think it's a wonderful thesis because it turns waste into gasoline. And everyone may think, well, gasoline, isn't that going out because you get all these electric vehicles? But even with the most aggressive assumptions of EV uptake by 2035 and 2040, we'll still have the same amount of gasoline by 2035 as we'll have today. And that's on a very aggressive assumptions. So it's a good market. The carbon footprint of the renewable gasoline is like a third of like a normal car. And actually, interestingly enough, because EVs sounds great because they don't emit any emissions, but they use electricity, it's been generated, a lot by coal and gas and other hydrocarbon sources. So actually, if you take the power of the grid and you dial in the emissions related to the materials to build an electric vehicle, actually for the next 20, 30 years, the projection is that the biofuels like renewable gasoline will actually have a lower carbon footprint. But the kicker here is to how I started the discussion on renewable energy. It's a perfect example where you use the existing system to get to the new system. Because this is renewable gasoline, but you can drop it in like any other gasoline. So you don't have to build charging stations. You don't have to build new distribution centers, no new pipelines. And the consumer behavior doesn't have to change. So you don't have to build a charger at home. You can just continue going to the gas station by using this biofuel, but having actually the effect of a better effect on carbon reduction than an EV would. So that's a little bit on renewables. Just let me finish on how we're putting that together and give you an insight what we're doing in Aurivas to manage this wide spectrum of energy opportunities. So we're investing in oil and gas. I showed you the Aurivas Permian and our ARP Energy Utah and Locan Oil Colorado assets that are playing big in gas. We're also looking at new energies. The biofuels fund that we talked about that's going to invest in virgin clean fuels is our leading investment there. We're looking at the helium, which I didn't touch on. And we're also incubating new energy ventures. And actually one that will launch later this year is 06, which is a carbon credit venture, which plays to the carbon markets. And we do some energy consulting for various companies. So let me thank you again for your attention. I think I love working in the energy sector. It's so fundamental to what people do, and it helps us move around, it helps us grow, it keeps us warm. And I think it's a great investment opportunity as well. And if you got any questions, now's the time for it, but you can also contact me in my email address or look at our website for more information.
Thank you so much. I enjoyed that presentation just so thoroughly. I always like talking about the oil and gas space. I just think it's so interesting, so phenomenal. I, of course, got the pleasure to hear a really large part of y'all's presentation at the expo and how, kind of even more detailed about how you started and did your research and everything. And I think that what y'all do as a company is just really amazing. So thank you so much for sharing all of that. We actually do have a question. I will put this, I did it all by myself. That was great. So Rashmi has a question. He missed kind of the early part. What is your forecast for the oil price, and what is the minimum investment for your project?
Yeah, well, I think it's always bad to give a projection for oil price.
I know, what a leading question. Just get your crystal ball out and tell us.
Look, I can see a lot of merit into what Goldman Sachs is saying, and they think by the end of the year, oil prices could be back at $130. I think there's a great opportunity at the moment where I get a little bit of weakness in the market. But you got to go back to the fundamentals. There has been years of underinvestment, and there's no significant reduction in demand in the future. So that typically leads to higher prices. On our fund, the fund that we got open at the moment is probably $25,000 minimum investment. And we take a range of investments at the moment. So,
which is really interesting and different from a lot of other companies that we hear from. That's on the lower end of what you can get into, some of these funds for. So I think that really opens it up for a lot more investors to be able to invest. So that's great. One of the things I know you talked about at the expo was how y'all actually get to one thing that we mentioned was, and you talked about it a little bit, was how some of the companies take care of their flare by doing other things with it. And I loved what y'all did, how you actually were able to incorporate that to use the energy to kind of to run your operations. And I thought that was something that was really unique that I hadn't heard of another company doing. Do you mind just kind of touching on that for a second?
Yeah, absolutely. It goes a little bit back to, I mentioned how important the team is. So when we buy an asset, actually when we bought this asset, a lot of the gas was flared. And that happens in other parts of the US. And as Nicole mentioned, some people say, okay, well, then we start running a Bitcoin mining operation or do some other stuff. And we just went back fundamentally and said, well, wait a minute, this is gas. We're an oil and gas company, so we produce it. So why don't we change out the compressors, which we did, to better optimize it for the setting, so we didn't have to flare the gas, which basically means you can take your gas in a lower pressure, you compress it, and you sell it in the gas network. So rather than just flaring it and losing that opportunity, we actually just were able to compress it, put it back in the pipeline system, and use it to heat houses and make more revenue for us and for our shareholders.
I just thought that was such a wonderful, interesting way that y'all did that. I had heard of more things that people were doing with the flare, kind of more of like in a Bitcoin or like an, what would you say, like an off-site more, but y'all really did it to invest in your company and to get more interest for your shareholders. And I just thought that was such a wonderful thing that this company did. I just really wanted y'all to have it. I just wanted y'all to get to mention that. So thank you so much for being here. I thought that this was such a wonderful presentation. I, of course, have such an affinity to the oil and gas world. So guys, y'all got the education, and now it's time to take some action to actually get to invest in companies like these. So make sure that you are contacting Quest Trust Company. We have the information down there. Of course, our wonderful guest, Mr. Dekker, has his information there if you want to contact him directly about exactly more about their debt funds, more details there. I know he would be happy to talk to you and share information. There's the website for the company. So again, thank you so much for being here, Mr. Dekker. It was really a pleasure. I'm so glad that I got to speak with you again from this weekend. It was just amazing. And to everybody that joined us today at noon, thank you so much for being here. Make sure you contact Quest. We'd be happy to help you open up that self-directed IRA to start investing in these oil and gas investments. So everybody have a wonderful rest of your day, wonderful rest of your week. We will be here same time next week, noon on Tuesday, for another great speaker on education for your self-directed IRA. So have a wonderful rest of the day, guys. Bye now.
Thanks.